Okay, there we are. Hi, everybody. Thanks for joining me this morning and taking time out of your day. I'm going to actually share a screen for the moment because I prepared a presentation for today, and it'll just help us walk through things. So you probably won't be staring at my face the whole time. I join you to take a look at the presentation once I get it up here. And there we go. I think everybody can see it now. So I'm just going to quickly transition into the show itself. Excellent. So thanks everyone for taking the time to pop into the to my chat today. I'm calling this one From Strength to Strength with a question mark. The 2023 Economic Review of Chemistry and a mid-year recap. And that mid-year recap is going to go over operational side of things, but also the policy side too, with a big focus on investments. I'm Dave Cherniak, Policy Manager, Business and Economics here at CIAC. So I wear a couple of different hats, but the biggest two for today's discussion is I'm the data analyst for CIAC on the operational economic side of things. So I kind of track business statistics and that sort of fun stuff, where chemistry sits in sort of Canada's economy. And I also wear an investment and competitiveness policy cap. So I look at things like trade policy, tax policy, investment competitiveness, all those sorts of things. So this is kind of my wheelhouse. Thanks for joining today for this discussion. And to kick it off, like I said, I'd like to call this one From Strength to Strength with a question mark. And as we go through, I think that question mark should become apparent, and it should also show where we're looking to see some strengths and perhaps some weaknesses here in 2023. So there's three things that I'd like to discuss during the presentation today. First and foremost is what is the 2023 Economic Review and why should you take a look at it? That's really the product that has brought us all here today, that was released last week in Chem News. If you haven't taken a look at it yet, please, after this, hopefully you'll be inclined to do so. Then, as mentioned, I'm going to touch on a 2023 mid-year update, what we predicted in the outlook and where we are at today. And then finally, dovetailing very closely with that mid-year update is Canada's investment landscape and the road ahead for low emissions investment tax credits, or ITCs. The focus here is on ITCs, but it's going to be a broader discussion too about Canada's investment climate. So what is the Economic Review of Chemistry and why should you take a look at it? Well, the Economic Review of Chemistry is an annual comparative report which situates Canada's chemistry sector, both the full chemistry sector and industrial chemicals, in Canada's manufacturing economy. I think this is like one of the key value adds that that the Economic Review offers. Is it's not just a discussion about chemistry and industrial chemicals, it's really a broader discussion about chemistry and industrial chemicals in Canada's manufacturing economy. That's really critical for chemicals and chemistry, where somewhere between 95 and 96% of all goods have chemistry as an input. And that includes the largest manufacturing sectors you can think of, whether that's metals refining, automotive production, housing construction, or consumer goods. Chemistry is at the heart of everything. So once we can talk about chemistry kind of within that framework and compared to other sectors within the manufacturing economy, I think it really helps illustrate, one, the importance of chemistry, and two, the relative size, something we don't really talk about that much, or something that's not really talked about that much in Canada's manufacturing economy. And so when you open up the 2023 Economic Review, what are you going to read? What are you going to see? Well, as you can see here from the list of metrics that we track, this is really a story about the economic indicators of the sectors. Things like shipments, aka product values, trade statistics, employment and wages, productivity and value added, all the sorts of things that if you were looking to compare economic sectors, these would be the ones you look at it. It's also a very robust database. Stats Canada has been tracking in very good detail the manufacturing sector of Canada's economy for a long time. So we know we're working with really good statistics in a lot of cases. We know we have a good track record and a long database to look into this. So there's not too many surprises anywhere else. This isn't just a Canadian phenomenon. Around the world, we're much better at tracking the manufacturing economy than we are the service-based economy. This is just, I think, over the years, it's much easier to count widgets than it is to count barbers and haircuts. But it's something that, we've become pretty good at doing. Lastly, when you go to the Economic Review, what you're really seeing is kind of a high-level aggregate look. That's partly a limitation of the data, but also partly just, how we talk about sectors that are so big in so many cases. But if you'd like a little bit more of a detailed investigation, particularly in the industrial chemical space, because that is CIAC's membership for the most part. Take a look at the industry profiles section towards the back. There, you'll find very in-depth discussions on things like the petrochemical subsector, the resins and synthetic rubber subsector. You'll see the amount of establishments, the shipments, the value and volume of trade. That's a very key part. You'll get a really in-depth look. So just to pull back, the Economic Review is a summary and comparative document for Canada's chemistry and industrial chemical sectors. It's one of the only few that I know of in this sort of format where you can see the different rankings of sectors by the different metrics we track. And also, it's a good discussion on doing deep dives if you're really looking at that. So that's the 2023 Economic Review. I would really encourage you to click on the CIAC website and poke through it. And as always, I love putting this thing together. So if you have any questions or comments as you're reading through, please, my email is attached to that document. I'm always happy to have a chat. So now that we've kind of gone through the pro forma, where does chemistry stack up? How does it fit into Canada's sector? Well, I like to focus on what I call the big three for these metrics. One of those is shipments, of course. The other is exports. Canada is an exporting nation, particularly for manufactured goods and commoditized goods like this, and also employment. You got to be able to say how much you're worth, how much you ship abroad, and how many people you employ. So where does chemistry stack up? Well, let's take a look here. This is in shipment value for 2022. As you can see, chemistry sits fourth. CIAC's members specifically in industrial chemicals sit a little bit further down, around 10th if you were to break down these subsectors. But chemistry as a whole is a huge sector in Canada's economy. Last year, petroleum and coal products had the year of all years. I'm sure everybody remembers the prices at the pump. But normally chemistry sits between third and fourth overall in Canada's manufacturing economy. That makes sense. In some cases, chemistry with the pharmaceutical component is a huge proportion of people's daily lives. But once you get below pharmaceuticals into things like industrial chemicals, which are defined as basic chemicals and resins, but also things like paints and coatings, soaps and detergent products, and fertilizers and other agricultural chemicals, you can start seeing just how important the chemistry sector is to the rest of the economy, how it feeds into so many different downstream sectors. So in an economy that is quite large for the manufacturing sector, it makes perfect sense that chemistry is right up there with all that. Particularly for food and transportation equipment and also building materials, chemistry is invaluable. It is the products that keep our food fresh. It is the lightweight components that we find in automotives. And increasingly, it is the sector developing solutions to ever more problems within those. That's something I'd really like to leave you with. I'd also really like to leave you, if you look down the chart here a little bit, and this is the one we'll kind of drill into, is chemistry is a fundamental part of each and every one of these. In fabricated metal production and in primary metal refining, things like sulfuric acid are critical components to actually allowing these sectors to operate. In wood products, things like chloralkali products are very critical in either taking wood products to paper product form or for helping to pressure treat wood to help it last longer. Ditto for plastics and rubber products, where of course basic chemicals and industrial chemicals are key ingredients to building secondary plastic products, which find their way into all sorts of things. So I just like to kind of really highlight those linkages, how chemistry kind of sits already at a very high value within the economy, but also is critical to the performance of those other chemicals. So now that we move past shipments, where do we stack up when it comes to exports? Canada's chemistry sector is hugely export-oriented. We actually trade a lot. If you look through the Economic Review, you'll see that imports actually in some cases are just as high, if not higher, than exports. That happens in a trade-dependent and heavy manufacturing economy. But as you can see, chemical products really punch up their weight too when it comes to overall exports. Third last year in value in 2023, and even industrial chemicals, a much smaller sector, you can see just how high those exports are. 24.9 billion exported from Canada of industrial chemical products every year, last year. A huge proportion of production is exported, particularly from Western Canada. And now what about employment? And this one is a little bit trickier to discuss because while chemical products do feature relatively high up. We have nothing like the overall employment footprint that you see in food production. And I see one of my numbers cut off. This is right around 210,000. Transportation and fabricated metals. That is because chemicals really are a capital intensive sector. These are highly automated processes in a lot of cases. And so while there is a huge employment component across the entire value chain, it just doesn't match up. You don't need as many hands or fingers to get these products to market as you do in some of these other sectors. So still a very large employer. There's absolutely nothing to shirk about for a sector that employs nearly 91,000 Canadians, and through indirect employment, which we estimate about a 5-to-1, nearly 400,000 Canadians, over 400,000 Canadians. That is absolutely nothing to sneeze at. But compared to our other two rankings, employment is always a little bit lower, even though our employees, the value add that they bring is among some of the highest in the sector too. So that's kind of a quick overlook where chemistry stacked up at the end of 2022. What does that mean in overall, though? And here's where I'd like to come back to shipments for a second. So if we look at, I'd like to zero in again on the industrial chemical side of this, because that is CIAC sector. So how have we seen that? Where are those figures that I mentioned kind of situated in the last few years, particularly the COVID years, but also going back before that? And as we can see with my chart here, I start off the economic review. We start off by saying it was a record year. Well, it definitely was. The end year of shipments for industrial chemicals, 11% higher than we saw last year. From 2018, which is largely considered the peak in the previous chemistry cycle for Canadian, even in some cases global manufacturers, look at that, 15.9% higher. On a constant dollar basis, we're still about 8.5% to 9%. So that's just showing that even when you take into account price differences, which have a huge impact on shipment levels, and we'll come to that a little bit later, last year really was impressive performance. And I'd like to draw your eyes to two things on this chart. First, of course, is the industrial gas figures. You can see the growth in that subsector of chemicals over the last few years. Incredible. Part of that is no doubt pricing, but a huge chunk of that is just growth. And going down to a much larger segment in organic chemicals, here too, a huge step in growth from 2018. This is going to be important when we talk about investment later on, but needless to say, this jump in organic chemicals, while some of it is price-based, this is the result of large-scale investments creating step change differences in production once they come online. A hallmark of industrial chemicals, if you will. So now that we've kind of finished off 2022, which again, a record-setting year, a very strong year, even though there was, as you saw there, a little bit of softness in the resin sector. How did we enter 2023? What were the big themes as we came into this year, and the ones that are still dominating the discussion now? Well, first among those is a full normalization from COVID. Now, I know in North America, it seems a little bit odd to be talking about this, but it's important to remember that it was just over 13 months ago that Canada cast off all of its restrictions around re-entering the country. It was in October last year when very large economies in Asia, such as Japan, Korea, Taiwan, and to a lesser extent, India, because they were a little bit different in how they handled it. But it was in October and November that they finally started allowing tourists or foreign travelers into the country that didn't have either permanent residency or were citizens. It hasn't been that long. China, for instance, only cast off its last entry restrictions for COVID in mid-April of this year. So the normalization of COVID, while it might seem like old news here in North America, a huge chunk of the world is still fully reopening from that, fully getting used to it. For anybody that's looked up flights lately to get to Asia, or especially if you've tried looking at China, things aren't back to normal yet, that's for sure. There's lots of reasons, some geopolitical, but just to that point, that COVID still hangs over a lot of the world economy. Of course, we can't go anywhere in 2023 without talking about inflation and tight monetary policy. That's a carryover story from 2022 and in a lot of cases 2021. But the changes in the economy, the surge in consumer prices, the surge in the cost of living in a lot of different places, we're going to touch on part of that in a minute, and the monetary policy response from central banks with interest rates going from zero, or in the case of many European economies, negative, to the highest since before the financial crisis, that's obviously quite the change, the largest change in 15 years at the fastest pace in about 4 decades. So to say that that's not weighing on expectations and consumer minds right now, that you'd have to be living under a little bit of a rock to suggest that. So clearly one of the mega trends. Another, and it's very tightly situated within these first two, is of course diverging global economies. North America having reopened in a lot of cases led by the United States, but also Mexico and Latin America opening at a faster rate than many other economies after COVID. It is in a bit of a different sort of space than North Asia or China in particular, which are still kind of shaking off those restrictions, but also, other economic issues that have laid on there. China in particular, dealing with a bit of a property pricing hangover. We know, looking back at the United States after the financial crisis, and then in Japan in the 90s, what can happen when that goes absolutely south. But China's still working its way through that. Another country that I don't see getting enough attention, and I'm going to keep banging this drum for years ahead, is actually India in this case. A country that seems to have finally found its footing when it comes to growth. And most projections now have it situated between 7 and 9% growth over the next few years. In fact, if you look at it, India is likely to become the world's third largest economy ahead of Germany by about 2026, 2027. So that country is experiencing huge growth. The rest of Asia and North Asia still shrugging that off. Europe in a bit of a predicament, and that's going to touch on our fourth megatrend here in 1 second. And North America, not doing bad, not doing great, still clearly in growth mode by what we're seeing right now, but definitely fighting different headwinds while also sharing tailwinds. And what's the fourth megatrend? Well, that's energy security. And a lot of this is, of course, related to the war in Ukraine and what has happened since, but energy security definitely fell down the radar of policymakers over the preceding decade or so, thanks large part to the shale revolution, thanks in large part to climate change related policies and the rollout of renewables. But after last year, after the rerouting of commodity flows, particularly those of natural gas, crude oil, and fertilizers and those sorts of things, energy security is now top of mind, something that investors and also policymakers are really, really considering after about a decade of not having to worry that much about it. So those are the 4 megatrends. Coming out of 2022, as you saw, Canada's chemistry sector and its industrial chemical sector were near record levels. So what were we predicting for 2023? What did we see in the outlook? Well, I took a little bit of a contrarian view in this, and I had us growing. Now, I've given a pretty big band around this, 0 to 5% sales growth, but I have the sector growing. Definitely within. Moderating prices are a headwind in 2023. There's no more could. They are a headwind. But the impetus for growth, I think, is still there. And that's what I'd like to touch on kind of as we move forward. But before we do that, I would like to get your views. Poll question. Oh, and I may not have activated it. Give me 1 second here. Oh, I may have to stop screen sharing. Sorry, apologies. Give me 1 second. The poll is now live, and I'm just going to go back to sharing. So we're going to come back to the poll questions and the answers a little bit later, but I would like you to take a look here and consider the poll question. As you consider our outlook for the value of shipments of chemistry in 23, where do you foresee chemical shipment values from 2022? Is that idea of growth too high? Is it going to be a lot more growth? Is it going to be flat or quite a bit worse? I'd like to hear your opinions on that based on what you're hearing, and particularly if you are in the chemistry sector itself, what you're seeing. Predictions are one thing, but what you're seeing on the ground is another. So please take some time, answer that poll question, and we'll come back to it a little bit later. And so what was it that, with that in mind, what sort of things are we tracking now? Where do we see the performance of the sector at this point? Well, as I introduce it here, hopefully as you've looked at that poll and you remember what you said, growth isn't looking too good for my prediction at this moment. But, and I would say this is crucial, but it's still quite early. We do know there's quite a bit of softness in resin markets right now. That's been one of those issues that was kind of put off or pushed back during COVID. But there is a bit of a supply-demand mismatch, kind of at a global level, not so much in North America in particular, but at a global level, there's a bit of softness. Some of these other metrics, particularly for basic chemicals, you're very much within the range at this point. Spring tends to be a bit more of a maintenance season. In some cases, we also get another bump in fall, but not too far off the pace. And crucially, there's some things to play out here in 2023 still that I think could take us from the red a little bit here and bump us a little bit closer to those black lines. And what would those be? Well, the 3 or 4 things that really drove my thinking when I put together the outlook was one, that the pessimism coming into 2023 seemed a little bit high based on the momentum in the back of the economy to me. So things like a record number of housing units in North America under construction but not yet completed. Auto production that still had not caught up to pre-COVID levels, despite a record backlog in demand and reservations. The same for aircraft, which are a huge component, and some industrial investment. And this one's a little bit trickier to pin down. It's kind of a moving target, but different sectors such as machinery products, such as infrastructure investing. We know from different bills throughout COVID, whether in Canada or the United States, that those should be hitting high gear right about now. There was a lot of talk about them being for COVID, but it's really tough to get shovels in the ground immediately. A lot of those had delays in it. So I think there were quite a few different metrics that were showing that we're going to see continued strength. Very recently, a couple of days ago, if everybody was, if folks happen to be paying attention, a record number of monthly housing starts in the United States. Canada trading a little bit lower, but still above pre-COVID levels. And I think that's something that, we all need to anchor to a little bit. The last couple of years have been so different in so many ways that we're kind of forgetting about what happened before that. And in a lot of cases, the trends from pre-COVID in 2019 and earlier, we're still performing above those today. So even though we might have come off the boil a little bit with the COVID related demand impetuses, we're still growing stronger than what we were pre-COVID. That's important to know. Another one here, investments in Alberta and Ontario are moving to full operation. They're not quite there yet, but the Nova Chemical expansion in Corunna, a huge expansion there, is moving its way into full operations. Ditto with the Interpipeline investment, the Heartland Petrochemical Complex in Alberta, moving to full ramp up from its initial start last year. Those should provide base growth in a lot of cases that is just going to kind of happen, assuming those ramp ups continue, regardless of pricing. And that's a very big part of what we kind of expect to support the industrial chemistry sector here in 2023. We also have positive trade linkages, and this is really important in a number of different ways. First and foremost, it taps us into that very strong US economy and increasingly a very strong recovery in Latin American economies. I'd like to say Latin America is kind of the bellwether because they've dealt with an awful lot more inflation shocks and central bank tightening than I think most Western governments have. But we saw those countries act quickly to tighten, act quickly to pause, and then to see their economies slowly picking up steam here in 2023. So those trade linkages, Canada's linkages also, our export infrastructure allows us to tap into markets that maybe are having a bit of trouble with their own production. Think here again, Europe with the energy shock. We did see exports trickle up materially in 2023 to European counterparts in ways that we hadn't seen for quite a while when we looked deep into the data. So those trade linkages, the stronger momentum behind the North American economy, and the ramp up of these investments were really 3 important reasons why we thought that the sector could continue to grow this year, despite the headwinds we saw coming. And as a fourth, and this requires a little bit more unpacking, is Canada's energy advantage. And I use the word energy here because it's not just one product, it's multiple. And this too kind of provides, I guess, a floor of support in a world of elevated or volatile energy pricing to Canada's chemistry sector. And how do we see that? Well, what do we see with that? Well, let's take a look here. Let's dig into this energy advantage a bit more. I'm about to show you three of my favorite graphs. I apologize already, they're a little bit noisy, but these three are some of my favorites. So the first one here is, this is the resource pricing index for natural gas. This is the natural gas that Canadians consume. This is the pricing trend of it since the year 2000. It is one of ever continually dropping costs. We see here a little bit of a bump in 2022 with the energy crisis last year, but that was nothing compared to the cost of natural gas and its associated products about 15, 20 years ago. Absolutely nothing. So we're still fully in a declining natural gas environment. That is critically important for Canada's industrial chemical sector, which relies very heavy on fossil fuels as its feedstocks. Now, of course, that's not the only part. There is a lot of electricity-based electrochemistry, but that too faces a very similar story to natural gas. A lot of that relies on legacy hydro or legacy nuclear assets to be cost competitive. Very similar to natural gas because they're legacy. They don't fluctuate too much. They stay relatively low. Now, if we think about global chemistry and the global pathways to production that rely much more on crude energy products, not just natural gas, but things like crude oil, things like naphtha, and in some cases, coal-based chemistries, we get a very different graph. Now, again, this is for Canada, but it does track similarly across the world. This is a very different graph when you include everything save for natural gas. Here, the story isn't one of declining, particularly in the last year and a half. Here is something a floor perhaps in the wrong direction to higher prices. And what do we see when it comes to something like basic chemicals? Where do the producer prices kind of lag at this point in the cycle? Well, let's take a look. Now, which graph does the basic chemical index remind you of? If you had to compare between these two, what's the index? Well, it tracks a little bit closer to the crude energy. It tracks a little bit closer to those very broad pathways that kind of underlie global chemistry deployment, and that makes sense. Chemistry is commoditized markets. Everybody, in essence, unless you are very, very large, is a price taker in this. And well, the vast majority of production pathways for chemistry outside of North America are in crude energy, not on natural gas. So it's not a shock that the industrial product producer prices are a bit higher. But if you think about our production pathways here in natural gas, and you think about this index chemicals here, can you see where the advantage pops up? That's Canada's energy advantage when it comes to something like industrial chemicals. That is a huge, huge benefit to our manufacturing economy, but specifically to chemistry, as other countries grapple with pricing volatility. And as we mentioned earlier, energy security remains top of mind among policymakers. So those are the four kind of meta themes that are really keeping Canada, that I believe will keep production quite strong in Canada. Despite some of the headwinds we've seen, there is underlying momentum. There are investments coming online. There is Canada's energy advantage. And we have strong linkages into markets that don't have these same characteristics. That's a pretty good setup in a sector that's commoditized and one where customers are always competing for the best price. We're going to shift a little bit now to talk about those investments. I've talked about two, but a big story for Canada's chemistry sector is that we're fully in growth mode. Unlike some sectors who are worried about preserving market share, we're looking to grow it. And a huge component of that today in 2023 is the low emissions investment opportunity. So we've already discussed 2023, we'll see the ramp up of two world scale investments, but what's happened since 2021 is way more interesting. In the last 2 years, we've seen 25-ish announcements for industrial chemical projects in Canada. Now, some of those are completely new. There's a lot of talk about battery materials, And that's fantastic. That's entering into a brand new market, and we're really hoping to win that. But more than 2/3 of these investments are actually for either existing assets or to expand existing assets in low carbon ways. That's really that's a sea change from before. This idea of growing production while lowering emissions is now top of mind for investors, not just policymakers, but for investors. That's key, and we're seeing it reflected here. Again, crucially important that investors are looking at this, not just. The problem we have in Canada is that we have 25 announcements. We don't yet have 25 final investment decisions. We don't yet have 25 shovel in the ground projects. It's great that there's lots of talk, but we've seen this kind of before. We saw this in 2017 during the last wave, lots of announcements, 2 very big projects, excellent. But what's announced and what actually comes to fruition are 2 different things. So it's great that we're seeing this interest, but we have to go from talking to building. And that's the next step for this. That's where we're going to get into Canada's supporting environment, the policies that are trying to drive this. And what are those? Well, right now, Canada has focused its investment attraction, particularly in low carbon areas for chemistry, around investment tax credits. If you haven't heard a little bit about these, a lot of these are focused on reducing the capital cost. So if you invest X, you get a proportion of that back as a renewable tax credit. But this is the route that Canada has chosen. And we have 4 major components to this under discussion right now. The first, of course, is clean hydrogen. It's a tier-based approach. We saw quite a bit of detail released in Budget 2023, specifically the tiers. These bullets are some of the issues that we're watching with it. We think there's a lot of potential here, but we really got to take a clean look at those, at the threshold minimums and how they're worked out. We really need to figure out what we're doing on combined heat and power, because that is such a critical part of chemistry. It really helps, 1, make processes more efficient, but 2, also helps distribute the energy load a lot more equitably. There's some interesting things about that. We don't have retrofit costs. And unfortunately, methanol was not labeled as a potential pathway for clean hydrogen, despite its many uses. The focus on ammonia was great. That it was nice to see energy carriers mentioned, but we need to see methanol in there too. We got to keep pathways broadly open. That's a key part of this. We've also seen carbon capture, storage, and utilization. A secondary announcement here from what came, the refurbishment inclusions on CapEx, that's excellent. At least in that first 5-year period, we know that equipment is going to need an overhaul, and it was really good to see the government acknowledge that. Same with the combined heat and power. That was omitted from the initial tax credit, but we saw it come back. So, and we also saw the inclusion of tie-in costs, which is excellent, because CCUS in Canada really is going to be a story of brownfield redevelopment. There will be, of course, some greenfield, but a lot of sites will need to include CCUS on existing operations, and the tie-in cost there can be quite substantial. So it was nice to see the government acknowledge that. These 2 tax credits are, I think, clean hydrogen and CCUS are the most advanced at this point. We do not have official legislation yet, so that's unfortunate, but we do see a lot of good in these. More work needs to be done to tighten them up. That is for sure, and to make them the best possible tax credits they can be in this case to compete with what we saw in the IRA. Slightly down the line, we also saw announcements for clean manufacturing and clean electricity. I think what we would like to say on this, because members are looking at a variety of solutions, a variety of pathways to lower emissions on their sites, is that the government has kind of focused so far on pinpointing specific technologies to include. We think it's very difficult to do that when so much is unknown about the future. Picking pathways now versus creating broad-based credits that could apply to a number of different participants presupposes you know how things will change. If anything that's come out of the COVID pandemic in the last few years is that is incredibly difficult to pin down, incredibly difficult to predict. So, we'd like to see the broadest possible use of these sorts of credits. We'd like to see the most technologies. Technology agnostic is the ideal scenario, to let the economy build around principles instead of around pathways. That, I think, is a really important thing if you could take away today, is we'd like these tax credits, again, to allow the economy to grow around principles, the principle of decarbonizing, the principle of using clean hydrogen, not necessarily a specific technology pathway that we pre-writ in to regulations for a variety of different reasons. The final stage that Canada is undergoing right now is actually a discussion on carbon contracts for differences. We won't get too much in these, but CCFDs are a way to kind of bridge the gap between today's world and the one in 2030, 2040, or 2050, where carbon prices are a lot higher. It's very difficult to take that sort of future to a bank or to an investor when you really don't know how political cycles will play out. CFDs are an instrument that kind of bridges that gap, helps bring investor certainty. There's two routes for these currently about to go under discussion. One for the Clean Growth Fund, which the setup legislation, I believe, achieved royal assent the other evening, and a broader-based consultation, which we expect to begin in the fall. Please keep your eyes on our releases for more thoughts on these, but needless to say, CCFDs, along with the aforementioned tax credits, that is a lot of Canada's approach to luring chemistry investment and low carbon investment in particular. They aren't specific to chemistry. They are much more broad-based, but these are the four we're really looking at right now as ways to move forward. But from the positives, there's always some headwinds. And in this case, regulatory policy and uncertainty is still quite high in Canada. Why is that? Well, we have things like the looming oil and gas sector emissions cap. If you think back to Canada's energy advantage that we discussed a little while ago and the reliance on fossil fuel feedstocks, you can see why this is a very uncertain time. We need a stable supply of fossil fuel-based feedstocks for the chemistry sector's prosperity. What will come out of the emissions cap? That has the potential to weigh on that future. We're still waiting to see what the government's approach is going to be. The clean electricity regulations too. Obviously, electricity, a huge part of Canada, of the energy component for producing chemistry. A big question there is, where does hydrogen fit in? Whether it's clean, blue, gray, I don't really like colors, but where does hydrogen fit into those regulations? Is it allowed to satisfy some of them? Yet to be decided, something we're watching for. Carbon pricing and the opportunity to create value. This is critically important. Because right now, a lot of industrial emissions that are subject to carbon pricing kind of go into a general revenue fund. Now, a lot of it is earmarked for low carbon solutions, but that doesn't mean it goes back into the sectors that are paying for it. And as we look forward, the intensity-based metrics that Canada is using for industrial carbon pricing, they're set to tighten at the same time as carbon pricing is set to rise too. Having those revenues flow back to industry would enable the value creation. Also, having a way to ensure that simply investing in something like CCUS isn't whittled away by carbon pricing becoming tighter and tighter and tighter before the investment pays for itself. That's another thing we're considering. Again, being able to create value through low emissions investment is critical. You can't just expect companies to do this out of the goodness of their heart. There has to be a value proposition. And this is one of the areas where we think things could be modified going forward to provide that incentive. Finally, infrastructure investment. Will we be able to transport and trade the low emission products we're investing in? In a lot of cases, Canada's trade linkages are a tailwind. They're very supportive. We can get products to global markets. But when we're talking about a sector where investments go not in a line, sort of like this, but when you have step changes. Well, if you think of those 25 investments, all of them which come with a proposition to raise production while lowering emission, the question comes, can we transport and trade that new production? I think it's a discussion we have to have, particularly when it comes to moving certain types of energy carriers in the hydrogen value chain. There are really big discussions to have with transportation and trade companies to make sure that everybody's rowing in the same boat. This will be a long conversation, but a very important one to make sure we can actually move the products we're producing to global markets. And this is going to bring us to our second poll question of the day, which is Canada creating the right conditions to attract new investment to meet our climate change goals? Now, climate change, remember here, that is now wrapped up very tightly with investment decisions broadly. So lower emitting, higher production. Are we creating these questions? We'll have to take a look. I'm curious to hear your views on this. And that does bring us to the end. I'd like to thank you for your time. We're going to move on to the fun part now, which is just kind of a broad-based Q&A, if there's any. We're going to take a look at those poll questions first, but I'd like to thank you for your time. I will be able to go back and click through the slideshow, but I just have to bring a couple things up here. So if questions around that exist, always happy to discuss more. But I'm just going to hit stop share for a minute so I can bring things up, and you'll have to pay attention to my head. And we're going to open this too. If folks would like to type in, or if you'd like to talk, feel free. I'm going to just quickly look at my poll questions here. Okay, so first things first. Where do we see chemical shipments heading in? Well, the good thing is here, flatter than a board came out #1. Hey, that's better than the red that I kind of showed everybody. So good to see that folks were kind of in the same boat. That 0 to 5%, I think, is a pretty safe space, but good to see that I wasn't too off there. Here we go. Is Canada creating the right conditions to attract new investment? Well, a fun one here was that I tried to do my best to not get too deep into it, but I know it's going to come up. The Inflation Reduction Act looms very large in discussions of low carbon investment, and I had to put that in as a result. So more than half of you suggest the IRA has stolen the spotlight, and I think a couple believe that the devil is in the details when it comes to these products. Nobody said yes, we're on the right track. And I think at this moment, I think I'd have to agree with that assessment too. There's a lot of good things to like, but we're not quite there yet, especially with the fact that we haven't really moved these things forward in a tangible way. It's great that we're discussing, but nothing is real yet. So I'm going to close this poll. I open the floor to questions among everybody, and I'd like to hear your thoughts. So Bob, the floor is yours. Oh, and you were on mute.
David, you there?
Yes, I can hear you now.
Sorry, technology. Sorry about that.
Yeah,
trying to figure my way around unmuting on this platform. Just curious. I mean, it is such a mixed message, but a mixed environment. But when we went through COVID, you had such a pull on things like record demand for mattresses and refrigerators and furnaces, fridges, televisions, all kinds of things that require a lot of chemistries and a lot of high valued chemistries. Is part of the softness, if you will, just that demand was pulled so forward so fast during COVID that it's going to take time for household formation and new demand to pull some of this back into the economy?
I think that's definitely the case. Like we have seen when you kind of look at the composition of the growth that we've seen over the last, at this point, I think 12 months for sure, maybe even going back 18 months, the shift from goods, which was really the hallmark of COVID, into services has been real. But it also hasn't plummeted for goods. In fact, a lot of people have been quite surprised just how strong goods demand has been. I think the question going forward is, two things really. One, how much does that excess the backlog of things like housing under construction, how much does that feed into the demand for a lot of products, particularly like appliances, bedrooms, furniture, those sorts of things? There is a huge number of units that will need to be outfitted once they're ready. What does that do to the demand for physical goods? That's a good question. The second two is a lot of sectors. I'm thinking particularly automotives, and I know for a fact aerospace, but of course that's not you and me purchasing airplanes. I don't think anyways. those sectors still remain in a deep backlog. People have been waiting years at this point for vehicles. So how long do some of those, I guess, backlogs, uh, how much does that, I guess, offset some of the weakness from pulling that demand forward? Those are good questions. And I don't have particularly great answers for them. I'm like everybody, I'm kind of watching the churn and seeing automotives, for instance, surprise everybody, I think, with how strong they are. And then odd things, like like even iPhone shipments, softening a bit. So just some weird things out there. But consumer demand, particularly home balance sheets in North America broadly, not necessarily certain pockets of Canada, are in incredible shape. And if the sale of autos, which are now returning in the last few months to pre-COVID levels, are any indication, consumers are willing to spend. It's just not kind of a direct fire hose on physical goods like it was during COVID, that's for sure. Anyone else with any questions today? Okay, not seeing too many, but I'd like to get into the chat, I guess, because two areas that have been, I think, a lot softer than people anticipated, particularly is China. The last few months or weeks, it really seems like negative news out of China has dominated the news cycles. But I think everybody is really wanting to move very quickly on China. But I would stress that in a country of 1.4 billion people, with an economy roughly very close to the size of either the United States, or I think it's actually larger at this point than the EU is, you can't turn an economy on a dime. The property sector is definitely a problem in China, but you also do have several hundred million Chinese consumers at or near North American and European levels of wealth. And, they're finally getting to explore either China or the globe for the first time, really, since February 2020. So let's just see what happens over the remainder of the year for that. I know there's a lot of negativity now because folks expected things to be so much better so quickly, but China, given its size, is one of those that if that starts to roll and snowball, the momentum that it'll bring, similar to the American economy, could continue for a long time. So I think the jury's still out there. Europe is a little bit of a more difficult situation. Europe's chemistry sector in particular is sized for export at the moment, and has historically been export oriented. But the energy crisis has thrown a really, really big wrench into how that operates. So I think what happens with Europe over the next year to 18 months is going to be really critical to, kind of the global chemistry supply and demand balance. There's some sizing that could decrease there if producers decide that the energy volatility is simply too much. And I think, broadly speaking, that would be to benefit of North American producers who retain. I talked about the Canada energy advantage. It's really the North American energy advantage. We're quite linked, with the exception of electrochemistry here in Canada. But the fossil fuel-based pathways, we're very closely linked on that, and it's a North American advantage. So something to watch, I think. Those two, how the Chinese economy and the European economy is kind of evolved, that's going to be top of mind. North America, there's so much momentum right now that I think you'd be relying on the proverbial black swan event to really hit that momentum, despite some of the leading indicators. It's just tough to see how things get terribly bad at this point. All right. Anyone else today? Any other questions? Well, I would like to thank everyone. A little bit of a smaller crowd. I think that's partially due to the summer solstice last night. It's tough to sit and chat about chemistry when summer's right around the corner. But I hope everybody learned something today, took something away from this chat, and hopefully you'll click and take a look at the 2023 economic review and learn something through that too. Again, that's a fun publication to put together. It's one of the few ranking ones where we can actually sit and score points against our manufacturing counterparts, but hopefully you can find some value in that. And it's very early, but I would like to plug, there will be another webinar very similar to this as we close out the year, I think in early December, to have a chat about, well, how did some of these predictions go? How did my rose-colored glasses view on North America versus some other economies shape out? How did the chemistry sector respond to these convulsions, to these seismic changes that Bob kind of addressed here? We're going to have a much better view on that come December. So hopefully you'll be able to join us on that. And we'll make sure that invitation is out a long time ahead so you can pop it in your calendars. But unless there's anything others, give it a second here. Thank you very much for your time today, everybody. I hope you learned something, and I hope you found value in this.